Hello and welcome back to the F50 Capital Summit Austin 2021. Today's panel is going to be on legal considerations. My name is Roger Royse. I'm a partner with the law firm of Haynes and Boone. I'm resident in the Palo Alto office, but I am joined here today by two of my partners from Austin. Kellie Bobo is a partner in the Investment Management and Mergers and Acquisition Practice Group in Austin. And we also have Adam Sencenbaugh, who is a partner in litigation, labor, and employment in Austin. In today's panel, we're going to talk about some of the legal issues that emerging growth and venture capital concerns have, especially those working out of Austin. I'm going to share my screen now because we do have a set of slides that we're going to share with you. So as I said, there'll be three panelists today. I'm your moderator and also one of your panelists, Roger Royse. I'm a corporate partner with Haynes and Boone. Adam Sencenbaugh is a litigation partner and employment partner in Austin, and Kellie Bobo is a corporate partner and investment management in the Haynes Boone Austin, Texas office. So let me just start off with, we'll go in succession here, and I'd like to start with some of the corporate issues that emerging growth companies have wherever they start up, especially in Texas. So some of the first issues we think about are entity formation, ownership, and capitalization. And this is a pretty good laundry list of the high-level issues. You know, the first question is going to be choice of entity, but if you're a startup company and if you're on a venture capital path, as you probably know, you're going to end up being a Delaware C corporation. We could spend an hour talking about the considerations that go into that decision, but usually if you're taking venture capital, that's where you end up. Once you've made that decision, that actually defines quite a bit of what's going to happen next. For example, how you're going to compensate and reward contributors. Your founding team will have stock. If there's more than one, that stock will be subject to vesting. I'll talk about that in a minute. Some of your service providers might have stock. They're more likely to have options. And then there are other types of more exotic instruments used as equity compensation that we can get into. After that founding team is put in place with the common stock, either granted as restricted stock or in the form of options to acquire stock, the company is going to fairly quickly, if it's a startup, be out raising capital. First money usually comes in as some sort of convertible instrument. That would be a note that converts into stock and in the next financing, or what we call a SAFE, a simple agreement for future equity. Think of it as a convertible note that doesn't get repaid, it gets repaid in stock. The next stage would usually be, and sometimes companies go right to what we call a priced round or preferred stock, or early on, Series C preferred. And this is actually stock, just like the common stock that the founders have, but it has various rights and preferences. In other words, it gets paid first in the case of an exit or an acquisition. It also has different sorts of managerial considerations. The difference between Series C preferred and preferred is usually one of stage. And this changes. What used to be Series A preferred is now Series Seed preferred or Seed preferred. Sometimes you even get, Seed A, C1, Seed A1. And the idea is that the market sort of demands certain metrics around every letter of the alphabet that you get to. And oftentimes you'll see people bend over backwards to correctly categorize their preferred stock as something other than an A or a B round, just because they want to be in a certain place in terms of founder ownership, valuation, and growth metrics. I mentioned vesting briefly. If there's more than one founder in a company, they should vest. By vesting, I mean that when somebody, a service provider who's been issued common stock in a company, leaves the company, they have to give that unvested stock back to the company, and they vest into it over time. And I say give it back, but they actually sell it back at cost, which is usually pretty close to nothing. So that's a vesting period. You always want that. Sometimes there's triggers that will accelerate vesting, change of control, termination of service. These days, You rarely see what they call a single trigger. You will sometimes see for senior level people like founders, vesting accelerating when somebody leaves within a certain amount of time of a change of control. Sometimes vesting is imposed on financing, sometimes it's imposed on an M&A. What I will say is that a lot of times people will start off with between 3 and 5 year vesting. I usually go with 3 years for founders and up to 5 years for optionees. Just keep in mind that if you're on a venture capital path, you're going to end up unvesting and revesting again and again as new rounds of financing come in. So in my experience, founders should expect to vest for about as long as a venture fund lasts, which could be 8 years. So don't get too tied to your 3-year, 5-year vesting. That's a deck, an economic deck that gets reshuffled with almost every financing. Other sorts of transfer restrictions will apply to your stock. Most importantly and significantly is the right of first refusal. It's really hard to say that somebody owns stock if they have an absolute restriction on transfer. That may not be enforceable. So companies don't absolutely restrict transfers. They just make it really hard to transfer. And the way you do that is through a right of first refusal. It guarantees that the company knows who their shareholders are going to be, because if you, a founder or somebody else who has common stock in a company, like an optionee who's exercised their options, wants to sell stock, they have to offer that stock back to the company first at the proposed purchase price. And the company can buy it or not. There's a very strong, healthy secondary market because it's gotten so hard to go public anymore. There's a strong secondary market in common stock by optionees who have exercised and now they hold their stock and they want to get some liquidity. So they'll go through this process and the company, will hardwire it, get a waiver in advance or an understanding that they're not going to exercise their ROFR. And then that stock can be, sold to a third party. It's usually a fund that a special purpose vehicle put together to collect a lot of these shares. Anyway, it all has to be done subject to this ROFR. Now, when the investors come in, there's a whole bunch of other provisions that will apply. The lockup is a promise by the shareholder, or I guess a restriction that prohibits them from selling their shares within a certain amount of time of a public offering. That should be in place for every shareholder of the company. When the investors come in, they're going to demand a couple of other things, in particular, co-sale rights. They're going to want their own right of first refusal. Beyond that, they're going to want a co-sale right. What that means is that if the company, if the founder finds a buyer for their shares, they have to bring the investor along with them so the investor can get liquidity at the same time. A drag along is just the opposite of that. It's if the investor finds a buyer, they can force the founders to participate in that sale so they can get some liquidity. You'll find every once in a while you see those seep into pre-funded companies, into common stock and the founder stock purchase agreements. That's not really the norm, but someday it might be. I want to mention something about the investment climate before we turn it over to Kellie to talk about raising a venture fund. So early on, usually the first money in the early stage money is going to be in terms of convertibles. And a convertible note is just that. It's a promissory note that converts into stock upon the closing of the first equity financing, usually a preferred stock financing. And it converts usually at a discount because you reward people for putting their money in early. So for every every 80 cents they put in, they get $1 worth of preferred stock. And it also usually converts subject to a cap. So their money's going, a valuation cap. So their money is going to convert at no higher than a certain valuation. So they're guaranteed a certain percentage of the company early on. Very common terms, very standard stuff. A SAFE, a simple agreement for future equity, which more and more people are using, startup companies are using, is like a convertible note, but there's no interest element to it. It does not have a short term, doesn't have any term at all usually, doesn't have to be repaid. It converts into stock or it just participates in an exit or proceeds of liquidation. So keep in mind that that's the way that companies get financed before they get to a preferred stock financing. Now, I do want to give you a warning. These things are so easy, right? They're so easy to do that it's very easy for a company to sell a lot of itself without really knowing about it, because the instrument that they sold doesn't turn into equity till down the road. So they take the money now, but they don't have that equity percentage on their cap table. So you don't really know how much you've sold until you do that preferred stock financing. That makes it a little bit of a dangerous instrument because you might give away a much bigger part of the company than you think. The second thing I'd caution you about is that not all safes are created equal. And I do a whole hour on these sorts of things that you can find online if you Google. But the important point to note is that you can't go online and just download a form because sometimes they convert at a pre-money value and sometimes at a post-money. It's usually better for the company to convert at a pre-money. If the safes that convert at a post-money valuation mean that they're not going to be diluted by all the other safes in the round. And that can lead to some really odd results. It gives you some certainty as to how much of that company the safe has, is represented by, but it also gives the investor a much better deal. So you really have to think through this. And then finally, safes are oftentimes accompanied by a pro rata rights agreement. In other words, you want to give the investor the right to participate and maintain their pro rata percentage in later financings of the company. So that's it at a high level. With that, I'm going to turn it over to Kellie to tell us a little bit about venture capital funds.
Yes, so I'm Kellie Bobo, and I'm going to take it just a step back and actually talk about those investors that are actually investing into these venture capital companies that Roger just spoke about. And a lot of times there will be a fund raised specifically to invest in different venture capital portfolio companies. And there's three main regulatory schemes that really need to be navigated when you are considering raising a fund to be an investor in these different venture capital portfolio companies. The first one, and the one I'm going to talk about the most, is the Investment Advisors Act. And so generally when you raise a private fund, the manager of that fund will be giving advice on investing in different securities, in this case, the securities of the underlying portfolio company, in exchange for compensation. And that gets you into the Advisors Act scheme. And generally, if you fall within the definition of an investment advisor, you have to register with the SEC, which is very burdensome, has a lot of regulatory considerations, and generally, especially for venture capital fund advisors, want to try and find ways to avoid registration with the SEC. And the most common way to do that is with the venture capital fund exemption, which is very specific, and it's found in section 203, one of the Investment Advisors Act on a federal level. And if you are an investment advisor solely to a defined quote unquote venture capital fund, then you would be exempted from the registration requirements under the Advisors Act at a federal level, no matter how many assets you manage. And so this is a very interesting exemption that we often try and get our clients to be able to fit within, because an alternative exemption is one if you are just an advisor to a private fund advisor, but you have to have less than $150 million in regulatory assets under management. And so the benefit of this venture capital fund exemption is that no matter how big the fund gets, no matter how, hopefully the fund will be an investor in multiple portfolio companies and be doing very well, and RAUM can get above 150 million, and the advisor does not have to register with the SEC and be subject to all of the provisions of the Advisors Act. And so first I'll just walk through what this exemption entails. And there's five requirements to be able to qualify for this exemption. The advisor must be an advisor solely to venture capital funds. And what's the solely, that means that there cannot be other clients that you have, whether it's a separately managed account, whether it's just a pure private equity fund, or a pure hedge fund investing in securities on the public market. It can only be to venture capital funds. And a venture capital fund is defined as no more than 20% of commitments are non-qualifying investments. So the purpose of this is that most of the investments, they want them to be in the venture capital companies Roger spoke to you about earlier. And generally that means that the qualifying portfolio company has to not be a reporting company. So this is at the early stage of development of the company before it goes public, the whole point of being the venture capital fund and going through all of these different rounds of financing. The second requirement is that that portfolio company doesn't issue debt obligations and give you proceeds in connection with the investment by the venture capital fund into the company. This is a long-term investment that the investor, being the venture capital fund, will make into the portfolio company. And as Roger said, whether you're starting out at one of the early stages of financing or later on, the point is the money is not coming from that portfolio company right away. The value is not realized until a certain event. And the third one is just that it's not a mutual fund or some other sort of private fund, right? We're not getting at a fund of funds concept here. The second requirement to be defined as a venture capital fund is that the fund itself must be limited to borrowing only 15% of the fund's assets and can only be for short term. So we're talking about raising equity to make equity investments into venture capital companies. We're not talking about having a highly levered vehicle that's investing in the public markets or investing in private portfolio companies to turn them around. This is an equity raise in a venture capital fund for that venture capital fund to be an equity investor into venture capital portfolio companies. And then the last three are relatively simple. One, it's not registered under the Company Act. It's not a mutual fund, which I'll get into in a bit. And the second one is that there's limited redemption rights. The investors into this venture capital fund generally are not permitted to redeem. So they make commitments, and those commitments are given into different rounds of financing for the underlying portfolio company. And lastly, that the fund itself represents that it pursues a venture capital strategy. And so, as I said, if the venture capital fund that you are raising meets these 5 requirements and the advisor itself does not have any other clients, then you can rely on this exemption and do not have to file as an investment advisor with the SEC. Now, you also have to look at state law here as well. And in Texas, we have Texas Rule 139.23, which is gives a similar venture capital fund exemption for the definition for registering as an investment advisor in the state of Texas. And I would note that California takes a broader definition of what a venture capital fund is, but Texas relies on that federal definition by having those 5-prong tests that I stated. And if you qualify for the venture capital fund exemption at the federal level, you will also qualify for it at the Texas level. And now the requirements do depend, in order to claim that exemption, do depend on your level of assets under management. If you're under 25 million in assets under management, then all that you have to do is file as an exempt reporting advisor with Texas. And that's a very short Form ADV, very limited information about the fund and about the advisor itself, just to kind of let the SEC know that you're around. If the AUM, regulatory assets under management, is between 25 million and 110 million, and you're a mid-size advisor, then under federal law, if that mid-size advisor is exempt from registration at the state level, which you would be under 139.23 if you're advising only a venture capital fund, then the SEC requires you to also claim the exemption at the federal level, either register or claim the exemption. And so all this means is that if your AUM is over 25 million as a venture capital fund advisor, that you also have to file as an exempt reporting advisor with the Advisors Act. And that has 2 important considerations, just because not only are you filing that ERA report at both the state and federal level, you are also subject to the anti-fraud provisions of the Advisors Act, as well as the pay-to-play restrictions. And so that's why it's important to keep an eye on what your assets are under management so that you're complying with both federal and state law. I think the next 2 are relatively straightforward. So in the U.S. Investment Company Act exemption. This is generally in order to avoid being registered as a mutual fund under the Company Act. All the public companies that hopefully the underlying venture capital fund, venture capital portfolio companies will become eventually. You don't want to be registered as a company act under the Company Act because it has so many requirements and 10Ks and 8Ks and all of that. That's not the point here. We're not trying to do that. So you would have, there's two common exemptions. One is 3C1, which means if your venture capital fund does not conduct general solicitation, so all of the investors into the fund are, you have some sort of substantive pre-existing relationship with, and you're not generally, advertising on, we'll see stuff for Fidelity that's on the news, in the commercials. We can't have that. It has to be something with some sort of pre-existing relationship, and that you have less than 100 investors in the fund. Alternatively, an exemption that is common for venture capital funds is under 3C9, which also requires no general solicitation, but does not have a cap on the amount of investors. Though you do need to be below 2,000 to not be considered a public company, just to be clear. But that requires that all your investors are what's called qualified purchasers, which is a much higher threshold than what you probably are commonly know about for accredited investors. And generally, that means individuals or family businesses with more than $5 million in investments. And so those are the two most common exemptions that we rely on for venture capital funds to get you out of the Company Act regimen. The last one that we generally advise on to assist with getting the fund out of the Securities Act regulations is to rely on what's called Rule 506B, which I know Roger talk about in later on with respect to financing the portfolio company. I'm talking about it with respect to raising the fund. When you issue securities in the fund to your underlying investors, those securities either need to be registered or they need to be exempt from registration. And the most common one is the Safe Harbor 506B under Section 4A2 of the Securities Act. And all that this requires generally is that the investors be accredited investors, and also that you file what's called a Form D with the SEC, which is a very simple form that just states we've had this issuance of securities in the fund exempt from registration. It's only been to accredited investors, and we have not had any general solicitation. The last requirement to rely on that 506B is that you don't have any bad actors, which are certain disqualification events being involved in the fund's offering if they own more than 20% of the outstanding securities. So you can't have these bad actors if you want to rely on the underlying exemption. And accredited investors is generally, if you've got a joint net worth of about 200,000, it's a relatively lower threshold, especially from qualified purchasers. And the last thing I would just note is that depending on where you sold the securities of the fund in different states, there's different what's called blue sky filings, which is analogous to a Form D at a federal level, but requires different notice filings to different states depending on their requirements. And all that requires generally is giving the state a heads up that we sold securities here, here's a filing fee, and it was exempt on the federal level. And so I think those are just I know that was a lot of information, very dense, but the point is those are the three main regimens that need to be thought about when you're raising a venture capital fund in order to deploy funds into the different rounds of financing that Roger spoke about previously.
Okay, well, thank you very much, Kelly. That is a lot of information, but I'm glad to know that you're on top of all of this for the venture funds that are in Texas or moving to Texas. So we're going to turn it over, shift gears a little bit and turn it over to Adam to talk about employment issues. And this is one of those areas that differs quite a bit from where I am in California, doesn't it?
It does, absolutely. And so we're going to talk a little bit about some of the employment issues you're thinking about as you're coming to Texas, especially as a startup, and kind of what you should be on the lookout for. The first thing you want to think about when starting up is for your first worker you've identified, is that person or is that team going to be independent contractors, or are they going to be employees? Now, the important thing to remember for this is it doesn't matter what you call them. The label doesn't really mean anything. It really depends upon the relationship you actually have with them and how that is going to apply between regulators and the courts. And so, unfortunately, it's complex and there's several different tests that are in application. But the main ones I want to highlight are first are the Department of Labor and the FLSA's economic realities test. And what that looks at is, between the worker and the company, what is the real reality of that relationship? And it's a 7-factor test that goes through looking at things like, are the services the worker provides integral to the business? How permanent is that relationship between the worker and the company? How much is that supposed independent contractor contributed to buying their own supplies and equipment? What kind of control does the company have? And different things like that. And it's really sort of focused on the idea of, is that worker in business for themselves? Do they really have a business of their own? Or are they really just an employee that's been mislabeled? The other test that's becoming more prevalent now, that is familiar in California, but it's now, I think, going to be adopted by more states, is the ABC test. And that really, in order to call a worker an independent contractor under the ABC test, the company has to carry the burden of proving 3 different things. First of all, that they're free from the control and the direction of the hiring entity in terms of the work. And so they have some independence in the way they do the work. They have to prove they will perform work that's outside the scope of the company's usual business. And the classic example of that is, if you have an employee and an independent contractor side by side doing the same thing, that's usually going to be a problem. That's going to get spotted. And we always advise clients to be careful about that. Because if they're performing the sort of the core of your business, it's going to be hard to convince anybody that truly an independent contractor. And third, again, looking at the idea, is that worker, engaged in a trade or business for themselves? Do they have some corporate formalities? Do they have their own company that they're working for you through that company? Just calling them an independent contractor and giving them a 1099 is not enough. You really have to, if you want to be comfortable that you're not going to be found to have violated the FLSA or violated some other labor law because you misclassified them, you really have to look at how you relate to that worker and how those relationships, how those factors apply. Because with the new administration and with the growing prevalence of ABC test, I think you're going to have more situations where close calls, regulators are going to say that no, these are really employees, these are not independent contractors, and that can create a lot of headaches for you going forward, particularly if your business really depends upon that classification based on your business model to be profitable. Okay, so once you've decided, are they a worker or independent contractor, your next question, Roger, if you could hit the slide for me, is going to be, how are we going to pay them? Are they going to be salary? Are they going to be an hourly employee? Are they exempt or non-exempt from the FLSA coverage? And that's really important because, how you classify them is going to determine whether or not you have to pay them minimum wage, or have to pay them overtime, or comply with the different FLSA rules and requirements. There's a lot of exemptions to that, and they're very technical. And so, as you're thinking about the kind of role they're going to perform for you and what they're going to do, you want to make sure you've classified them the right way and paid them the right way, so you don't have FLSA liability from them going forward. Beyond that, you have to think about, are you going to pay bonuses to them? Are those going to be discretionary? Are those going to be mandatory? Are you going to offer them stock options or equity? And we've had a lot of clients with litigation around this because, they'll get started, they'll be, kind of in super growth mode, and they will be bringing employees on with sort of loose promises of equity or loose promises about, bonuses and things like that. And if that employee departs, and that's not really clear in the documents, it's going to be litigation, and you're going to be having to defend against a claim of, did I owe them a bonus? Do I owe them equity? And that's going to be a big expense for you. So you want to make sure that you've decided those issues are going in, so you don't have to fight a claim like that going forward. Okay. After you decided what you're going to pay them, next slide, Roger. You want to think about, does that worker come with any baggage? that is, when you're recruiting, you're oftentimes looking for people, that have obviously the skill sets you want, that have the qualifications you want in your industry, and likely, oftentimes, they're going to have worked with some of your competitors. And that's great because that gives them, sort of the skill set you want for the role. But the issue is that, they might come with baggage from having been in that prior position. They might have a non-compete agreement that you've got to deal with. They might have a non-disclosure agreement that you've got to figure out, what can you learn from them and what kind of role can you put them in based on those continuing restrictive covenants. They have trade secrets or IP from their former employer. It's happened so often now, it's almost become a cliche. But the worst thing you want to find out is, the last month, the last week, the last day that person was employed with their former employer, they stuck a thumb drive into a computer and downloaded lots of data and information that when they show up at your office on Monday, they feel like is going to put them ahead of the game and they're going to be a star employee because they know all that stuff. And then they put that stuff onto your system and you're dealing with a lawsuit from that prior employer saying that you helped them or somehow in concert with them stealing trade secrets or stealing IP. That's a nightmare. So you want to make sure that, if you identified somebody that you think is good, they don't have restrictive covenants that are going to give you a headache. They have not taken IP like that. And they're not going to bring problems to you that you're going to have to deal with just straight out of the gate with them. So really important thing to check as you're making that first hire. And obviously a background check is a good idea as well to make sure that there's no other kind of skeletons lurking out there as you're getting your feet on the ground. Next. Okay, so before they start, you want to think about as well, what kind of agreement should you put in place to make sure that you protected some of your, core company IP and some of your core customer relationships before that new employee even begins work. First of all, at a minimum, I think you want a confidentiality agreement and NDA. You also want to think about, should you have a non-compete for this employee? Non-competes obviously very disfavored in California, almost illegal in most instances. Texas, they're enforceable. And as long as you have your non-compete that's reasonable in time, in geography, and the scope of activities to be restrained, you can use those in Texas in a way to make sure that you protect your business from an employee that leaves and wants to compete against you. So you want to make sure that you've thought about if you want one, if you do, make sure you draft it very carefully so you hit those 3 requirements and you create one that is enforceable. This is often a part of the negotiations if an employee, starts and wants to fight about that, but you want to make sure that you've certainly considered it. Even if you don't require a non-compete, it's a good idea to think about a non-solicit agreement as part of that as well. That's there for, even if you don't want, you're okay with the person leaving to compete against you, you want to restrict them from going to the customers that they worked with or going to your client relationships and doing things that would otherwise interfere with your business, kind of going forward. So all those can be part of an employment agreement. That's really, kind of where you hash that stuff out and you could have each of those different clauses in there, but really important to think about to protect yourself from competition. Depending upon the role the employee plays, you might also want to think about one of these CIAs or PIAs, these proprietary or confidential invention assignment agreements. This is a great way to make sure that the work that you're hiring the employee to do, if they're creating IP for you, that you get the benefit of that, that you don't have a fight about ownership over that. Some states like California have some restrictions on that. And so California actually, by statute, restricts, how far you can go with these agreements, particularly if an employee has created this new thing on their own time without using your equipment, and it's not related to what they've done for you or your business. Other states, there's only a few states that have that. Texas doesn't have something similar to that. And so you have a little bit more freedom on how you can create those. But you want to make sure that if you do use a clause like that, that the language itself actually creates an assignment. There are sometimes fights about how that's drafted, but a really important tool in the toolbox to make sure that if you have an employee, and hopefully you do have an employee that has great ideas for you and really helps your business grow, that you get the benefit of that and you don't have fights later about who owns what they created and how and how that's going to break down going forward. Next slide, Roger. So even the best, employee, the best candidate, the best corporate officer just doesn't always work out. And so you got to think about, having done that stuff on the front end to protect yourself, what do you do as an employee departs to make sure that you protect the company and you don't have these kind of fights we're talking about going forward? The first thing you got to remember is that, even though Texas is an at-will employment state, terminating an employee an at-will employee still creates risk. It could, they could, depending upon what happens, they can, claim ownership rights over what they created. They can, want to take IP, take customers, all that stuff. And so you want to make sure that as a sort of baseline thing to do is to remind the departing employees that they have continuing covenants with the company. It's always a good idea to send them a letter. It's often a good idea to require them to inform a new employer that they have those covenants so that they put them on notice. You don't have a surprise from them going forward. You want to make sure you think about following, obviously, Texas payday laws, and make sure if you have a policy about unused leave that you abide by that policy. If you have a potential claim that you think that employee has some risks for, if they want to bring a claim against you, if you have some concern about that, think about a separation agreement. That's really important because, severance is not required in Texas for an employee unless there's some other agreement to give it. And so if you, want to provide some severance agreement that includes waivers of claims and things like that, that would protect you from later employment claims from this employee. And if all else fails, if you have an issue where the employee leaves and they have taken your trade secrets or confidential information or competing against you unfairly, you have some recourse through the Uniform Trade Secrets Act and the Federal Defense Trade Secrets Act to bring a claim against them. But you really don't want to have to fall back on those. You'd rather be able to address it through the contract that you've written and the employment agreement that you drafted that'll do a better job handling the issues the way you wanted to, as opposed to going to sort of the common law statutes for it. And the last thing I want to sort of leave you all with is that to remember that your employment obligations grow as your company grows. So with your first employee, you have the sort of minimum, you have the immigration issues to think about, workers' comp, make sure they're classified right. Are they an independent contractor? Are they an employee? Overtime issues, things like that. But as you grow, all the employment law statutes have different triggers for, when they become effective and when you become subject to them. And so at 15 employees, you become subject to Title VII and the ADA. At 20 employees, you've got the Age Discrimination Employment Act. At 50 employees, depending upon kind of where they're located, you get FMLA coverage. And so each of those as you go adds more obligations to you. So you want to make sure that, it's very common to be, sort of shoot from the hip and very, kind of loose with this as you first organize. But, as you grow, you have to think about, your obligations are going to grow and your need to be more formal about your policies and to sort of protect yourself from potential claims is going to grow. In addition to whatever state, and locality laws that might apply as well. In Texas, there's been several efforts to pass family leave and medical leave, paid leave. Those have all been tied up in the courts, but I think the trend is still there that we're going to see that at the state and local level as well at some time in the future. And so, that's going to be something to think about as well. So those are all some things those are the most common questions that we get, and some things to think about as you're starting up in Texas, adding employees to make sure that you can do so in a way that protects the company and allows you to grow well in the future. I'll pass it back to Roger.
Okay, well, thanks very much, Adam, and thank you, Kelly. That's a lot to think about for startups and emerging growth companies and venture capital doing business in Texas. I'm Roger Royse. I'm a partner with Haynes and Boone. This has been the legal panel here at the F50 Capital Summit 2021 Austin. Thank you for joining.